Good evening. I am positively surprised to see a huge audience on a Friday night. So I will talk about the global gold market and why gold is a strategic investment. Now, before doing so, allow me to quickly introduce the World Gold Council. Our mission is straightforward: to create and sustain demand for gold. Within our organization, we have investment, jewelry, technology, and government affairs. And our activities include research, marketing, market development. To give you an example, we open investment channel for investors. So we do have a physical gold ETF. I'm not selling tonight, just so you know what we do. Our head office is in London. I represent investment in China. We also have offices in India, Japan, Singapore, and US. And if you take a look at the right-hand side of the slide, you will see some of the largest mines in the world. So you have Barrick, Anglo Ashanti, etc. Those are our members. They sponsor us to advocate gold, to educate the market on gold. They add up to represent 60% of world gold supply. So this is the background. On this slide, this is not new information for you. And the obvious question is, of course, for you to ask, what is the gold price heading? As a matter of policy, my firm does not allow me to comment on gold price for obvious reason. We represent the gold mines. So what value am I going to add for you tonight? I'm going to share with you the demand and supply, the current statistics of this market. If you have this information, you can form a view on this market. And I am very optimistic about the development of the gold market. And hopefully, after sharing the information, you will form the same view, right? So, as you can see, in the 90s, gold went down to 252. So what had happened, I will talk about that. And then, from then onwards, it moved all the way to over 1900 US dollar per ounce. So I will talk about that as well. Another price chart, I would like to draw your attention to two time periods. You can see in 2008, gold price had fallen by more than 20%, and then it picked up again. And of course, you know, it was the financial crisis. One of the properties of gold is the fact that it is very liquid. So in extreme market shock, such as the financial crisis, investors redeem, repatriate, close their positions to cover loss. But after that, gold price picked up again. Now, in 2012, last quarter, you know that in US, there was the fiscal cliff, followed by the European crisis. I can't say which direction gold price will go from now onwards, but in my slides later on, I will give you some examples, some extreme economic market events, and you will see how gold can protect the portfolio. As you all know, gold is denominated in US dollar, but even if you were to see it in all different currencies, performance had been strong. It ranged from 11% to 20%. To understand the gold market, let's look at how it works. So for all the gold that is above ground, all the gold that we have dug out, right? It was 171,300 tons. That translate to around 9 trillion US dollar. And 49% of which was in jewelry. 17% in the hands of central banks, and then another 19% in investment. The next question is obviously, okay, now we know how much gold we have on the ground. How about the gold beneath, underground? We estimated 51,000 tons. In the last 10 years, annual mine supply was about 2,500 to 2,800 tons. At this rate, gold will be depleted in around 20 years. But of course, there are two assumptions. The assumption A, gold price does not go up further. Because if gold price were to go up further, then the currently uneconomical mines will continue to be mined. Let's say for South African mines, they're very deep, they're expensive to take. And B, no major new mine discoveries. And as you know, it had been difficult to find big mines. So a quick conclusion, this resource is scarce. If that slide does not give you an idea how much gold we have, this one should give you some visual representation of how much gold we have, right? It's like a 20 meters cube if you put it in the city of Hong Kong. So we know that the resource is scarce, but if we look at the financial properties, look at the value, right? So we are comparing the gold in investment versus other debt markets. It is a meaningfully large market for investors to invest. It is smaller than United States Treasury, the market cap of US Treasury, but it is. The market is bigger than a lot of debt markets, as you can see from this slide. And volume, in fact, it is even higher than most of the bonds. A lot of people are saying that, gold is in a bubble because a lot of investors have already entered the market. We have done an analysis, so we compare globally how much money has gone into money markets, bonds, equities, alternatives, some major asset classes. If you look at it, then only 1% of investor has entered into the market. So that argument does not seem to, hold. This is an important slide. It helps us to understand how the gold market works. Let's start with the left-hand side of the slide. You see the demand in 2001 and the supply in 2001. So demand is made up of jewelry, 81%, investment, 9%, technology, 10%. And for supply, the bulk of which was mine supply, 66%. And then official sector sales, 14%, and recycled gold, 20%. Let's look at 2011. As you can see, demand has become more diversified. 43% jewelry, 10% technology, 37% investment, and 10% from central banks. Central banks are not selling, they are buying. And this is not a single year phenomenon, and I will give you more data later on. And so you can see demand has become more diversified. Now look at supply in 2011. Supply, 62%, and as I have said earlier on, for the last 10 years, mine supply annually was around 2,500 to 2,800 tons. So to support the more diversified and larger demand, recycled gold has to respond. So why there would be recycled gold going into the market? So we are saying that you're willing to sell your jewelry back to the market. This actually explains why in the last 10 years gold price had risen for 6-7 times, because if gold price had not come up, then you might probably not willing to sell your jewelry. So of course, for recycled gold, it includes not only jewelry. You have gold in your iPhones, your computers. Those constitute to the supply of recycled gold as well. We are very affirmative of the health of the gold market based on 3 reasons. And the first driver was investment demand. You can see that demand has grown for the last 10 years. In fact, after financial crisis, investors have rediscovered the importance of gold in their portfolio. And in 2003, a new product was launched. It was actually the physical gold ETF. In the past, a lot of institutional investors cannot access the gold market because within their investment scope mandate, they simply cannot buy commodities. But with gold ETF, it is securitized, it is 100% backed by gold in some of the products, some of the gold ETF products. So that opened up a new channel for institutional investors. And you can see from this slide, the purple part is gold ETF. And this product had not taken away traditional demand from bars and coins. They grew together. And other chart to show the growth of global gold ETF. The examples given here are all gold ETFs that are backed by physical gold. You might have heard of products that are backed by derivatives, swaps, right? So those represent certain counterparty risk. So in the current financial system, actually gold has a growing role. To give you some examples, in 2010, 2011, exchanges such as LCH, ICE, CME, they are accepting gold as collateral. And commercial banks use gold as well. We use Turkey as an example. The commercial banks in Turkey can actually take gold to be counted as part of the reserve ratio. Last but not least, you have central banks. Central banks are building gold reserves. They wanted to diversify from US dollar. And you might ask, right, the European countries are going through difficulties. Why can't they sell their gold reserve? Right? I had 3 observations. First of all, when the government has issued, it's not the mandate for central bank to help them. They are managed separately. 2, actually, Greece, Spain, Portugal, if they were to sell their gold, actually the gold cannot cover their current needs. And so if they were to sell it, it would create a certain negative signal to the market. Now, there is an example on Russia. In fact, Russia in the past had used its gold reserve as a collateral for borrowing to become a secure loan, right? This might be something we will see in the market in Europe. So this is the first driver. We continue to see investment demand to grow. Investors no longer consider yield only from an asset class. They look at the return from your portfolio, right? And I will elaborate on that later on. Second factor, China factor. Gold demand in China has been growing very strong. China is in fact the largest producer of gold. But as you can see from this chart, they have to import. And the market is established in 2002 when the Shanghai Gold Exchange was established. And so the market is still young in China. We continue to see a lot of room to grow. Investment demand, again, growing. You might know that in China, the government has put on a lot of restrictive policies on housing. Asia market is not performing, and there is actually a lack of investment channels that also helped gold as an investment. But I guess the importance is the fact that China, like India, have a strong affinity to gold in their culture. So we have looked at investment, and again, consumption has grown in the last 10 years as well. And I think the reason, what is driving Chinese demand, it's the long-term growth story. If you believe in China, the long-term economic development, you will see why gold will continue to grow, right? When income grows, both investment and consumption continues to grow. So that concludes the second factor. Now we come to the third driver, which is central bank. In one of the first few slides, you see that in 1999, gold hit a bottom, 252. In fact, back then, investors focused a lot on financial products, new financial products. They focus a lot on the yield of and return of a investment, for example, like a bond, etc. In 1999, in fact, central banks are selling, and UK, for instance, Gordon Brown, back then Chancellor Exchequer, Chancellor, I can't recall the term, anyway, is responsible for the sale of half of the reserve in UK. And in that same year, European central banks come together. They decide not to put further pressure on the market, and they sign this central bank gold agreements. And with this agreement, they agreed to sell only 400 tons per year to the market. And in principle, US and Japan also adhere to this agreement. And the agreement continues to roll 2004, 2009, so supply had been contained. Now let's take a closer look. So in fact, in the period during the first central bank gold agreement, all central banks sell up to the limit. But as you can see in this chart, in central bank gold agreement 2, 3, central banks are no longer selling, right? The reason is because the European central banks are seeing the value of gold in their portfolio. It protects the reserve, and this is what happened in Europe. And let's look at Asia and emerging markets. In fact, they are buying. Again, of course, China, for instance, they have a huge reserve which is denominated in US dollar. Gold represents an excellent diversification to its portfolio. And in fact, a lot of other banks are buying as well. So this quarter, the National Bank of Kazakhstan openly suggested that, okay, I will buy up my own production. I will increase my target of gold accumulation, and the reason is the fact that they wanted to reduce the reliance on US dollar, right? So that is another example to which we see central banks' interest. And again, this is not a one-year phenomenon. You can see the black, the negative bars actually represent central banks buying. So starting from 2009, second half, central banks have been buying. And so far this year, central banks have bought in 250 tons of gold. If this trend persists, if we go to 500 tons, in fact, this will be a historical record after the gold standard. central bank if they were to buy 500 tons of gold. On this slide, I have a hypothetical analysis. So green bars, European banks, if they add their reserves together, gold represents 57.7%. But on the lower half of this table, you see Asian countries. If we put all our gold together, it represents only 2.6% of our total reserve. So let's assume if this trend continue and Asian banks' reserve increase to 15%, that would actually translate to more than 17,000 tons of gold. And of course, this is very positive to the gold market. So this concludes the reasons why we continue to see the gold market will continue to grow. It's a healthy market. So I should quickly wrap up. I have spent half an hour, I suppose. So why gold? Effective diversifier, US dollar hedge, inflation hedge, and I think the most important point is insurance policy. Why? So let's go through some of the benefits of gold. In this slide, I use a standard portfolio with allocation to equities, fixed income, and cash. If we were to include gold, starting from 0% to 5% to 10%, you can see that the information ratio improves. So what is the information ratio? So for per unit risk hold, your return actually improve. So that optimize your portfolio. And of course, gold is negatively correlated to US dollar. Gold performs well in inflation. Given the current crisis, I don't want to oversimplify, but I think without ample liquidity in the market, it is very difficult to overcome the prices. And I also mentioned that gold can protect your portfolio in extreme events. This chart gives you some example. In 1987, the Black Monday, long-term capital crisis in 1997, 9/11, 2002 recession. So if you had gold at that point in time, it actually protects your portfolio and reduces your loss. So I think to finalize my presentation, we see why gold, the reason why gold has grown in the last 10 years. It is a very, it is caused by a diversified demand and a limited supply. And by including gold in your portfolio, it provides risk management and capital preservation. So to give a very simple example, we are not saying that investors should allocate 100% to gold, but instead, let's start with 5%. Now, when you have 5% in extreme economic conditions, it protects your portfolio, and if you needed the liquidity, you can sell gold, right? Now, if the market actually rebounds, your 95% other asset classes, including fixed income equities, should provide a very good return to your portfolio. So this is why it is important to have a strategic asset allocation to gold. So this concludes my presentation. Let's see if you have any questions for me.
Thank you, Jammy. Could you
Thank
please
you.
give me a round of applause? Thank you. Questions, ladies and gentlemen? Maybe I would ask this question because I think to investors that come to me, can gold give dividends? Do I get return from gold? We've seen products that give that, so I'm going to ask these questions.
Wow. Normally, gold does not provide a yield, but in certain special cases, depending on the lease rate, you might come across such products. But let's say if gold does not provide yield, the same argument hold. We invest in gold because with gold in your portfolio, it adds diversification, and in extreme cases, it protects your portfolio and it gives you something for when you need liquidity in worst cases. So I think that's the right way of looking at gold.
idea of the price of gold over the years. Do you have statistics on the production cost?
Right. In 2011, the so-called total cash cost is around 1,100 to 1,300. And of course, that varies from mines to mines. If you have a shallow mine, then it would be way cheaper. But if it's deep, then it can come up. So that would be an average number.
You don't seem to represent any of the gold mines.
Well, we do not comment on the individual equity, and so you don't seem to relate us to these gold mines. We advocate the investment in physical gold, and if you were interested in gold mine equities, of course, you can have consideration, but again, it is a consideration of your risk objective, return objective. When you invest in gold mine equities, it carries the properties of an equity, right? So by default, there is leverage. You buy in the management, you buy into the prospect of them discovering new mines, etc. So the consideration is not the same.
Yeah, with the government now printing money, everything in short supply in billions, how far can it go? The price will go?
Right. That is difficult because I can't comment on gold price, but you know, this does not answer your question directly, but I think it is interesting to share. Let's say in 20 minutes, based on the money supply of US, they have already printed 35 million US dollar. But at the same time, our gold mines can only duck out 12 400-ounce bar. So this gives you a feeling of the value of our fiat currency versus commodity.
Can I assume that some gold mines are listed? Would you advise investors to go and buy the shares of the gold mine?
Actually, I would say, again, consider your risk and return objective. Gold mines, listed companies, they are correlated to equities as well. So not only are you exposing to gold, but also the management, equity, etc. I have no preference on specific equity or gold mine, but yes, it represents a different opportunity.
The last question, ladies and gentlemen. It was Friday evening. If there are no questions, can you please give Jammy a round of applause?
Thank you.